But here's the real question. Why do options exist?
Imagine a farmer. He plants wheat in the spring, but the harvest will only be ready in 6 months. And between now and then, many things can happen. The summer might be too dry. Heavy rain could damage the crop. Fuel prices may rise. Inflation may increase his costs. So the farmer works today without knowing what price he will receive in the future. Now imagine the other side, a bakery. They need wheat every day to keep the business running. But their costs could rise. Salaries, energy, bills to pay, and often they borrow money from banks to finance their operations. If interest rates go up, their costs could increase. If the economy slows down, demand could fall. Less product, fewer sales. So just like the farmer, they face the same risk, uncertainty. So the farmer and the company decide to make an agreement. Today, they agree on a price for the future, a price that will be used when the wheat is delivered. Now, both sides have certainty. The farmer knows how much he will receive. The company knows how much it will pay. That agreed price has a name. In finance, we call it the strike price. But price is not the only thing they agree on. They also agree on time, exactly when the wheat will be delivered and when the payment will be made. That moment has a name. In finance, we call it the expiration date. But there is one more important element. The company may pay a small amount today to secure the deal. That payment has a name. In finance, it's called the premium. For the farmer, this money helps run the farm. He can buy seeds, fix equipment, prepare for the harvest. And even if the company walks away, the farmer keeps the money. But here is the key idea. This agreement gives the company a choice, the right to buy, but not the obligation. If prices go up, they use it. If prices go down, they walk away. The company buys the option. The farmer sells the option. So if the company decides to exercise, the farmer must sell. That's why the farmer gets paid up front for taking the risk, the premium. So what happens if the company walks away? The farmer still owns the wheat. He can sell it to someone else, sell it on the open market, or wait for a better price. He's not trapped. He got paid today and still controls the asset. This is why options are powerful. One side gets flexibility, the other gets paid up front, and both reduce uncertainty. And from agreements like this, modern options markets were born. The future is uncertain. Prices change, markets move, risks appear. But in an uncertain world, options give you a way to plan ahead, to manage risk, to stay in control. If you found this helpful, subscribe to follow the full options series, because this is just the beginning. The next video is coming soon.